Spirit Airlines, the low-cost carrier known for its no-frills approach, is facing some serious turbulence. The airline industry is notoriously cyclical, and right now Spirit is caught in a perfect storm of challenges. Weak second quarter 2024 results have investors worried, and the stock has taken a beating. But is this a buying opportunity or a sign of worse to come? Spirit's ultra-low-cost model has always been about squeezing every penny of profit. They offer bare-bones fares and charge extra for everything else. This works great when times are good, but when the going gets tough, it can be a recipe for disaster. Right now, Spirit is facing pressure from all sides. Overcapacity in the domestic market is driving down fares, and high fuel costs are eating into profits. To make matters worse, the broader economy is showing signs of weakness, which could lead to a decline in air travel demand. The big question is whether Spirit can navigate these headwinds and come out stronger on the other side. The airline has a history of resilience, but it will need to make some tough choices to survive this storm. One of the biggest challenges facing Spirit right now is overcapacity. Simply put, there are too many seats chasing too few passengers. This is especially true in the domestic market, where Spirit generates most of its revenue. When airlines add too much capacity, it creates a supply-demand imbalance that drives down fares. This is great news for consumers who benefit from lower ticket prices. However, it's terrible news for airlines which see their profits squeezed. Spirit is particularly vulnerable to this trend because of its low-cost model. The airline relies on high load factors, the percentage of seats filled, to make money. When fares fall, Spirit has less wiggle room to cut prices and still turn a profit. This is exactly what we're seeing in the market today. Domestic yields, the average fare paid per mile, have been declining for several quarters, and Spirit is feeling the pinch. In its latest earnings call, the company reported a significant drop in revenue per available seat mile, a key industry metric. To make matters worse, Spirit is also grappling with high fuel costs. Jet fuel is one of the biggest expenses for any airline, and prices have been on the rise in recent months. This is due to a combination of factors, including geopolitical instability and increased demand from a recovering global economy. High fuel costs are a double whammy for airlines. Not only do they directly impact the bottom line, but they also make it more difficult to compete on price. When fuel is expensive, airlines have two choices: raise fares or absorb the higher costs. Spirit has been reluctant to raise fares too aggressively for fear of losing market share to its rivals. This means the airline is absorbing a significant portion of the higher fuel costs, which is putting a strain on its profitability. In its latest earnings call, Spirit reported that its fuel costs had increased by more than 50% year over year. This had a major impact on the company's bottom line, contributing to a significant decline in net income. Section 4. Industry adjustments, Delta and United trim. Their sales. Spirit isn't the only airline feeling the heat. The entire industry is facing challenges from overcapacity and high fuel costs. However, some airlines are better positioned to weather the storm than others. Larger carriers like Delta and United have more flexibility to adjust their capacity and pricing in response to market conditions. They also have more diversified route networks and a larger customer base, which provides some insulation from economic downturns. In recent months, both Delta and United have announced plans to cut capacity in certain markets. This is a strategic move designed to reduce costs and support yields. By flying fewer seats, these airlines can charge higher fares and improve their profitability. While these capacity cuts might lead to slightly higher fares for consumers, they're a necessary step to ensure the long-term health of the airline industry. Section 5. Financial health check. Can Spirit weather the storm? So what does all this mean for Spirit's financial health? The short answer is that the airline is facing some serious challenges. However, it's not all doom and gloom. Spirit still has some important strengths that could help it navigate this turbulence. On the plus side, Spirit has a relatively strong balance sheet. The airline has been debt-free for several quarters, which gives it more flexibility to maneuver in a difficult market. Spirit also has a young and fuel-efficient fleet, which helps to keep its operating costs down. However, there are also some red flags. Spirit's cash flow has been declining in recent quarters, and its margins are under pressure. The airline will need to find a way to reverse these trends if it wants to avoid a financial crisis. One option would be to raise capital through debt or equity offerings. However, this would dilute existing shareholders and could be difficult to pull off in the current market environment.